Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and short squeeze dynamics. Today, we're putting a spotlight on a very intriguing microcap name that has popped up on our screeners, ZCMD, or Zhongqiao Inc. We're going to break down exactly what makes this stock interesting from a short squeeze perspective, explore its specific metrics, and walk through the mechanics of why a stock like this could be considered hard to borrow. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's jump right into Zhongqiao Inc., ticker ZCMD. This company operates in the healthcare and health information services sector, primarily in the People's Republic of China. Under their endemic brand, ZCMD provides healthcare information, education, and training services to medical professionals. It's a small player with a market cap of just $5.09 million, making it a true microcap. Looking at recent price action, ZCMD has seen some significant volatility. Today it's down 4.95%, over the last 5 days it's down 4.0%, and looking at the last 30 days, the stock has plummeted 52.71%. Volume today is also extremely low at 496,400 shares, which is only about 0.16 30-day average volume of nearly 8.5 million shares. Shows the ZCMD chart highlight price action. What is cost to borrow and why it matters? So why is ZCMD on our radar? It all comes down to something called the cost to borrow, or CTB. When you want to short a stock, you essentially borrow shares from a broker, sell them, and hope to buy them back later at a low price. But borrowing those shares isn't free. You pay an annualized fee, the CTB. This fee is a direct indicator of how much demand there is to short a stock and, crucially, how difficult or expensive it is to find shares to borrow. When you see a CTB over 100%, it means you pay more than the stock's entire value in fees just to hold that short position for 1 year. Explain with animation of borrowing shares. Why this stock is hard to borrow right now. Now, here's where ZCMD gets really interesting. Its current cost to borrow fee is an astounding 846.6% annualized. That's an incredibly high fee, signaling extreme demand to short and very limited supply of shares available. For context, most stocks have a CTB well under 1%. ZCMD's estimated float, the number of shares readily available to trade, is also very small at just 1.1 million shares. While the exact number of shares currently available to borrow is unknown to us, a CTB that high, combined with such a tiny float, screams hard to borrow. Our internal composite squeeze score for ZCMD is currently 47.5, which indicates moderate, not extreme, squeeze potential when considering all factors. Show CTB data on screen. Squeeze mechanics explained. So, what does it mean for a stock like ZCMD to be hard to borrow in the context of a potential short squeeze? A short squeeze happens when the price of a heavily shorted stock starts to rise. This rising price puts pressure on short sellers who start losing money on their positions. To limit their losses or avoid margin calls, they are forced to buy back shares to close their short positions. This buying action, in turn, pushes the price even higher, creating a snowball effect. For ZCMD, with its tiny 1.1 million share float, even a small amount of forced buying by short sellers could have a dramatic impact on the share price because there are simply not many shares readily available. Add to the crippling 846.6% cost to borrow fee, and the financial pressure on short sellers to cover their positions quickly becomes immense. Dilution risk check. An important factor to consider in any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, increasing the total share count and often pushing the stock price down. This can completely negate a short squeeze, even if the cost to borrow is sky high. The good news for ZCMD is that our checks found no recent dilutive SEC filings such as -1s, -3s, or 424BS within the last 90 days. So, for now, dilution from new share offerings doesn't appear to be an immediate concern for ZCMD. Recent reverse split watch. Another crucial piece of ZCMD's recent history is its reverse stock split. ZCMD executed a 1-for-3 reverse split on June 29th, which was 52 days ago. A reverse split reduces the total number of outstanding shares, in this case, cutting the float by 2/3, and proportionally increases the share price. Historically, many microcap stocks, particularly those that have undergone reverse splits, tend to see renewed volatility or price pop within about a month after the split. While ZCMD's split was 52 days ago, slightly outside that typical 1-month window, the reduced float is a significant factor in its current hard-to-borrow status and potential for outsized moves. Remember, this observed pattern is a tendency in some micro-cap names, not a guarantee. Before we continue, let's quickly reiterate this important point. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with ZCMD? While an incredibly high cost to borrow like 846.6% is a major flag, it does not guarantee a short squeeze. It can also signal that short sellers have very high conviction that the stock price will continue to fall, and they are willing to pay dearly to maintain their positions. Given ZCMD's massive 52.71% decline over the last 30 days and today's extremely low relative volume, it's clear the buyers have been in control. To see a potential shift, you'd want to look for sustained increases in daily volume, especially on green days, indicating renewed buyer interest. Keep an eye on any real-time changes in borrower availability, and of course, any sustained upward price action that could stop pressuring those short positions. Remember, with a market cap of only $5.09 million, ZCMD is a highly speculative microcap, and extreme volatility should be expected. ZCMD presents a very interesting case study for understanding hard-to-borrow stocks. With its incredible 846.6% annualized cost to borrow, tiny 1.1 million share float, and recent reverse stock split, it certainly has some of the characteristics that can lead to intense short squeeze dynamics. However, the recent price decline and current low volume are important to consider. As always, this is for education, not financial advice. If you found this deep dive into ZCMD helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what stocks you'd like us to cover next. Thanks for watching, and we'll see you in the next one.